Very happy Lodi to all of you. I hope you're enjoying your this festival. So should we start now?
Yes, sir. We can start.
Okay, fine. Okay, so let me introduce myself. My name is Amit Kumar Tiwari, and I am Delhi-based fund manager. So I'm managing one family office fund here at Delhi. Uh, I have got around more than 17 years of experience in the fund management domain. So our today's, the topic which would be concentrated upon the fundamental analysis of stocks, right? So I don't know how many of you have already, been invested into the stock market, or you are going to, get into it. So I don't have any idea, but I'm assuming that many of you have already been, investing in the, the stock market, or the, the capital market, right? And if some of you has still not, has not yet started investing, then I I suggest you to go for at least SIP, that is the systematic investment plan, to go with investing in the stock market, right? So let's start with the fundamental analysis of stocks. So that is the big disclaimer. That is the big disclaimer that all the data as well as the companies which we will discuss here, that should not be considered as any buy, sell, or hold recommendations, right? Because I am the NISM certified research analyst, but not CB registered. So this the entire analysis is only for the educational purpose, which actually I am sharing with you, so that actually you could educate yourself that how to deep dive into the analysis of the stocks as well as the industry as well as the economy, right? But it doesn't mean that I'm giving you any kind of recommendation that this stock you'll have to buy, or this stock you'll have to sell, right? It is only for the educational purpose. So now, so we will start with the very basic thing, that is the financial market. What is the financial market? So the financial market is a market where the transaction of the financial assets takes place, right? So what are the financial assets? Financial assets could be anything. That could be shares, that could be debentures, right? That could be the commercial paper, that could be the unlisted shares. So that could be anything, right? So the market where the transaction of the all the financial assets take place, that is called the financial market, right? And the entire financial market is divided into two categories. One is the capital market, second one is the money market. Now, what is the capital market? So the capital market is the market where you put the money or you invest the money for more than 1 year, right? If you are putting your money for the longer time horizon, right? Suppose that you are putting the money, if you are investing the money for more than 1 year, then this is called the capital market, right? And if you are putting the money or investing money for less than 1 year, less than 365 days, then that is called the money market. And the instruments where actually you are investing, these are called the capital market instruments as well as the money market instruments. Right? Suppose that if you are investing in the shares or the stocks, then it is always termed as a long-term investment. So that's why it is called a capital market instrument. Suppose that if you are putting the money or investing into the treasury bills, right? It's again the money market instrument where actually you put the money in the 90-day treasury bill, or 120-day treasury bills, or the NCT, certificate of deposits, so these kind of instruments where actually you investing the money for less than 1 year, this is called the money market. So again, the entire the capital market is again divided into two categories. One is the primary market, second one is the secondary market. Now, what is the primary market? So primary market is the market where first time any company is used the share, right? Suppose that you must have heard the name of IPOs, initial public offering. So IPOs is what? It's a primary market instrument, right? In the IPO, the any company which actually first time in its lifetime, first time they are coming with an shares in the market. So this is called the primary market instrument, right? It is you may termed as IPOs, or some other thing. In the secondary market is already a developed market where all the issued shares are the transaction of all the issued shares are taking place, right? where actually the shares which have already been issued by the company changes the hand. So this is called the secondary market, right? Got my point? So, and then suppose that if you want to invest your money into the capital market or into the shares, then there are two kind of analysis are there. One is called the technical analysis, and second one is called the fundamental analysis, right? So what is the technical analysis? I think you have already had the class on the technical analysis by Hardeep. So technical analysis is a short-term, investment strategy where the entire strategy is based on the price and volume of the shares, right? So if you want to invest in the market for a short time horizon, suppose that intraday or the positional trade, so there actually you need to understand the charts, you need to understand the technical analysis of the shares. And if you want to invest for the longer horizon, suppose that for 1 year, for 2 year, for 5 year, for 7 years, then you need to understand the fundamentals of the company or the industry or the economy as a whole. Right? Suppose that if you're working with an investment firm which could invest into entire globe, and suppose that you are working with Goldman Sachs or some other company, so and they are authorized to do the investment in entire globe. So they could invest into the Indian market, they could invest into the Chinese market, they could invest into the Vietnamese market, whatever it is. So then firstly you need to understand the economy of that country, then you need to understand the industry where you want to invest, and then you need to understand the company's fundamentals, that out of this in this particular industry, out of the the total listed the company, suppose that there are 15 companies are listed in that particular the industry domain, then which company are best one to invest or to put the money for the longer horizon of time, or the period. So, so this is called the EIC approach: economy, industry, as well as the company. Got my point? If you have any question, or if you want to, if you are not able to understand anything, you can either unmute yourself, or you can, write the question in the chat box. So when actually I will go through the chat box, I will answer all those questions. Right? Got my point? Okay. So now, what is the fundamental analysis? So the fundamental analysis is a technique that gives you the conviction to invest for a long term, for helping you to identify the attributes of wealth creating companies, right? So what is the fundamental analysis of the shares? So suppose that if you want to put the money, if you want to invest in any company or in any stock market, in any company share for longer horizon of time, what you need to do, you need to do the fundamental analysis. Now, what is the fundamental analysis? Fundamental analysis is analyzing the business model of the company, analyzing the revenue model of the company, analyzing the profit loss account statement, analyzing the balance sheet statement, analyzing the cash flow statement of the company, right? Understand the entire the industry dynamics, where actually the particular for investing in that particular industry would be fruitful for you or not, right? So this is called the fundamental analysis. So for understanding the fundamental analysis of any particular company, you need to firstly understand the business model of the company. Business model could be anything, right? Suppose that there are many companies which are B2B companies, like business to business companies. So they don't sell their product to the public at large, but they sell their product to the companies which actually producing the end product, which is going to the market or the public at large. So this is called the B2B company. Then there are companies which are B2C companies, business to consumer companies. Suppose that you can take the example of ITC, you can take the example of HUL, you can take the example of Nestle. So all these companies, FMCG companies, these are called the B2C companies, where actually they manufacture the product and that goes directly to the public at large or the consumer. So this is called the B2B company. Similarly, there is another kind of the business model that is called C2C, consumer to consumer. Now, what is the consumer to consumer? You must have heard the name of Amway. So Amway is what? Amway is consumer to consumer company, C2C business model, where actually the consumer sells the product to another consumer. So this is called the C2C business model. So B2B business model, B2C business model, and there are C2C business model. So business model could be of anything. I mean, so you need to understand what is the exact business model of the company, and the company is what is the domain area of the company, right? In the particular industry there could be many sub industries, right? So it doesn't mean that, suppose that there is a company which which is into this automobile segment. So in the automobile segment there could be many companies which could manufacture the auto ancillaries. Like there are companies, they are producing this the socket absorbers. There are companies which are producing this steering. So there are companies which are producing the tires. So so in a particular industry there could be many sub industries, and you need to understand that what exact the business model of the company, and what is the revenue model of the company, where the what is the revenue stream of the company, from where the company is getting the revenue, right? So this you need to understand. Now, what it takes to be the fundamental, you are into the market, and immediately you say that now actually the Reliance shares have already gone too much, and actually it is going down. For any reason, you don't know the reason why actually the stock price of the Reliance would go down, but you have the gut feeling that the Reliance shares would go down, and then you actually sorted the Reliance shares. Now, so this is called the complete speculations, right? So and the kind of investors or the traders who do this, these are called the speculators. They don't have any any rational reasoning for backing the this kind of decision. Then there is the traders. So who are the traders? So traders is clearly not speculating, but they are completely relying on the price and volume of the price and volume of the company's shares, and also they are relying on the charts, right? So they are primarily the chartists. They have certain indicators like the resistance, supports, MACD, EMA, kind of stuff, volatility. So VWAP, and then by using these kind of the technical indicators, they understand that whether the price of that particular share would go up or would go down. If that is going to be up, then they buy the shares. If that is going to be down, then they short the shares, right? This is called the traders. Third category is the investors. So the investors are always the long term investors. They buy and hold the shares for more than 1 year. Obviously it could be 3 years, 5 years, 7 years. It could be as long as 50 years, 30 years, whatever it is, right? And that is backed by the entire fundamental analysis of the company, right? So in fact, he is even prepared to buy more of his portfolio stock in case the market overreaches. Suppose that you have bought the share of Reliance, and suppose that Reliance share has gone down, for couple of days. Suppose that has gone down to 10%. Then because you have the conviction of Reliance, the shares, then again you are getting the cheap. You are getting the Reliance shares cheap. Then again you are going to accumulate those stock in your portfolio. So this is called the investors. Now, in the fundamental analysis, we always go for investable grade companies. We always invest in the investable grade companies. And now, which are those investable grade companies? So there are the two analyses are there. One is called the qualitative analysis. Second one is called the quantitative analysis, right? So quantitative analysis is that analysis where actually we go through the last 5 years or 10 years annual reports. We understand we understand and analyze the financial statements of the company. That is balance sheet analysis, profit and loss account analysis, as well as the cash flow statement analysis. Right. So this is called the quantitative analysis. Right. Then there is another part, and that is called the qualitative analysis. Right. So because in India there is a lot of problem with the corporate governance, right? So there is a lot of corporate governance issues in the recent past in this the Indian companies. You can take the example of Satyam, you can take the example of DHFL, you can take the example of Yes Bank. So there are many. You can get you can have many examples where there was the corporate governance issue in the company. So that's why that's a very that's a very well thought out thing, that we go for qualitative aspect and also go for quantitative aspect. So in the fundamental analysis, the entire fundamental analysis is divided into two categories. One is the qualitative analysis, second one is the quantitative analysis. So what actually we look for in the qualitative analysis? In the qualitative analysis, we understand the management background. Who are they? What's their, the professional background? What their qualification backgrounds? What is the experience of the management? What is the education of the management? Do they have merit to run the business? Whether any criminal cases are proceedings against the promoters, etc., etc. So these are the management. So we always try to get the feel that whether the management is capable of running this particular business or not, whether the whether there is no any doubt on the honesty or the integrity of the management for running this, the business. Second one is the business ethics. Is the management involved in scams, bribery, unfair trade practices, or the business practices? The day before yesterday, you could have heard about this, the news about this polycab. So in the polycab, the IT searches were there, were on in the polycab, and they found that around 1,000 crores of, cash sales they discovered. I mean, IT teams discovered. So this is called the business ethics problem with the company. Then the corporate governance, appointment of directors, organizational structure, transparency. Then minority shareholders. How does the management treat the minority shareholders like we people? Because if suppose that we are going to invest in any particular company, then we would be treated as a minority shareholder. Then how the management is going to treat us? Do they consider their interest while taking corporate action? I can give you the several examples of, the corporate governance practices, or the, there is the cheating with the minority shareholders, unethical business practices and all, right? So I mean, if you are aware with this, the financial market, or the, if you are, reading the financial newspapers and, watching this, the business channels, then you must be hearing about all those, the cases with many companies. Then the share transactions. Is the management buying or selling shares from the company through, clandestine promoter group? It means that many times it happens that the promoters, buy the share not from their own account, but from the other people's account who are related to the promoter groups, right? So this is this is also the, the SADI share transactions, this is called. Then the related party transactions. So that is the company tendering financial favors to the known entities. I can give you the one example. So there is a company, when actually I was analyzing one company's, the financial model as well as the financials, then I got a company where actually the promoter of the company was having the two different companies, and they are not related to each other. These are the sister companies. One is the listed, second one is the unlisted one, right? So, and the listed one's raw material was manufactured by the unlisted companies of the same promoter, right? And suppose that the raw material of the, the listed companies, the raw material is, suppose that in the open market, the rate of this raw material is, suppose that 155 rupees per kg. But because there is the sister concern of the same promoter which is manufacturing the same, the raw material for that listed company, then that listed company is, buying that raw material at the rate of 205 rupees per kg, right? So suppose that if they are going to, buy this same raw material from the open market, they will get at around 155 rupees per kg. But because this is the, company's sister concern which is unlisted, so that's why the 100% ownership with the promoter only. So that's why, for giving the benefit of, financial benefit to the unlisted company, they are buying the raw material at the rate of 205 rupees per kg. So this is called the related party transaction. So whenever you are analyzing any company's financiers, then you need to understand then what is the related party transaction and how actually they are transacting with the sister concern or the other companies which are related to the promoter, right? Then the salary paid to the promoters. Now, so is the management paying themselves very happy salary? Many times it happens that, suppose that there is a the promoters of the company are getting, 5%, 10%, or 15% of the profit earned by the company, which is, unfair practice. Because in the open market, because salaries must be, in a, equilibrium level. So if they are actually getting, the 10% or 15% of the profit earned by the company, then again it's a red mark or the red flag, when you are analyzing the company. Then the operator activity in the stock. You must have heard the name of, the operator is active in the particular stock, or something like this. So does the stock price display unusual price behavior, especially at a time when the promoter is transacting in the shares? Then the shareholders, who are the significant shareholders? You must have heard the name of, Dolly Khanna, Ashish Kacholia, Anil Agrawal, then couple of, other prominent investors in the market. So you always, try to get that feeling that whether actually any particular, suppose that Rakesh Jhunjhunwala. So suppose that Rakesh Jhunjhunwala has already bought any, particular, chunk in that particular company, then you must have, conviction that if the Rakesh Jhunjhunwala has already, if the company of the Rakesh Jhunjhunwala has already bought that, the share, then you have a automatic conviction that that share actually in the long run could do better, right? So that is again, the criteria. Then political affiliations, whether the company is politically affiliated to any particular political party or not, that again actually, creates a lot of trouble. I can, name many of the companies which were having the political affiliations, and once actually the ruling party is, opposite to that political affiliation, then they, their business, obviously hampers in that case. Then the promoter's lifestyle. What is the, if the promoter have flamboyant lifestyle or the simple lifestyle, that also, affect the stock price of the company. Then there is the quantitative aspects. So in the quantitative aspects, so the profitability at its growth, not only profitability, revenue and its growth, profitability and its growth, margins and its growth, what are the earnings and its growth, matters related to expenses, operating efficiency, pricing power of the product of the company, matters related to taxes. So all these are the quantitative aspects. So for the quantitative aspects, you need to understand and you need to analyze the financial statements. That is again balance sheet, profit and loss account, and cash flow statement. And then you need to understand whether there is a growth in the revenue and growth in the profitability. What are the margins? That is the EBITDA margin, that is operating profit margin, as well as the net margin. Whether the earnings and from where the growth in the earnings is coming from, matters related to. So all these aspects you need to. So I am just giving you the summary because, we have a limited time, so we cannot, go through the in the entirety of the, the financial statement analysis. But I'm just giving you the, summary of how actually you are going to do the quantitative analysis of, any company. So then the dividend payout, what is the dividend yield of the company, how much dividend they are paying, cash flow from various activities. Now, again, in this, in this sense, I would like to, I would like to say that the cash flow statement is much more relevant in all the three financial statements. I'm just giving the example. Many times it happens that for, for showing the greater sales, any company, because in the, in the market, many times it happens that there is a credit sales happening in the market. Credit sales means if the company is having the product, then their sales people go to the market and, drop the product to the, the stockist and say that we will come again, after 3 months, and if how much, the stock would be remaining, we would again actually take back. Otherwise, those stock which has already been, sold up, you can, give the money to us. So that is called the credit sales, because the cash or the sale in the form of money is not realizing at that time. They are only giving the product to the stockist, and after 3 months or 6 months, suppose that 25% product has already been sold up, but 75% has not sold up, then again that 75% again would come to the company again, and that would remain into this inventory section, right? So you need to understand that whether the inventory of the company is increasing or not. If there is a significant increment in the inventory side of any particular, and that's again the red flag, because it means that the actual sale is not happening, and the product or the, the product which has already been, showing the sold off, which is actually not sold off, and that is again taken back by the company, right? So you need to understand in this perspective as well. Then there's the debt, whether the company is debt free or less debt or high debt, whatever the, the debt position in the company, both long term and short term. Long term and short term means, long term means the debt which is taken by the company for creating some assets, right? The fixed assets. You may say, suppose that the company is, going to have their own plant and machinery and another, another manufacturing unit, then they need the long-term debt, right? So the long-term debt means that debt actually could be paid off in the next 3 years, 5 years, 10 years down the line. But the short-term debt means working capital loan. Suppose that there is the business cycle of the company where the company manufacture the project. Firstly, the company, purchase the raw material, then that is the, the work in progress, that is the under process, and then the final product, and after final product they, sell that final product, and then the money actually comes from the market or from the consumer. So suppose that the entire business cycle is, suppose that 6 months. Now you need to get the money for the 6 months for, operating this business cycle. So this is called the short-term debt, right? So this short-term debt is mainly of less than 1 year, and that could be paid off on a regular interval basis. So short-term debt is not a problem, but if the company is having a large long-term, debt, so then that's the problem. Then again, it's a red flag. So for this reason, you need to understand that what is the debt equity ratio of the company. So you need to calculate certain ratios. So debt equity ratio is one of the, prominent ratio from which you can understand that how much debt in respect to the equity the company is having. Then what is the working capital management, right? So how the working capital management is efficiently, done by the company. Asset growth, investments, and there are the financial ratios, which actually I've already told you, like, the quick ratio, then debt equity ratio, then debtors coverage ratio. So these are a couple of ratios we, need to, we need to do this thing. Now, where can I get the information about the company? So for an investor, the annual report, obviously I've already told you that the annual report is the Bible for the company. That must be the default option to seek the information about the company. Then nowadays there are, many websites as well as the apps which give you the ready-made, the financial ratios and kind of things like, the screener.in, then money control, and then a trend line, and then, so there are many, tijorifinance.com. So there are many sites are there which are available for you to get a ready-made, the financial ratios. So you need not to go to the annual report, pick up the, the items, and then do their own homework on the, the Excel. So rather than all these, these sites or the apps give you the ready-made, the financial ratios from where you can get the data and you can analyze the things. All right. Now, what does the annual report contain? So, annual report contains the financial highlights. That is, again, the cash flow, the balance sheet, the profit and loss account, management statement. Every word is important on the qualitative side, right? So, what the management is, saying about, his own company, and what is the projection of the management for the next 1 year or 2 year down the line for the company. Then there is the MDA section. MDA means management discussion and analysis. So that actually, that section actually discusses the threats and opportunities in the industry and how the company is going to have in the, in the near future, as in the next year or next 2 years or next 3 years. 10-year financial highlights, corporate information, directors reports, reports on the corporate governance, financial sections, notice, as well as notes to accounts. So, I mean, all these sections are very much important when you are analyzing the financial health of the company. I can give you one example. So there is one item that is called the contingent liability. Now, what is the contingent liability? The contingent liability is the liability. Suppose that the company is having some, the litigation. Suppose that any, litigation is there to the company, and company is fighting a, legal case in the court. Now, so this is called the contingent liability. Contingent liability means suppose that if the company loses that case in the court, then maybe the company have to, bear the cost of $10 million or $20 million or 250 crores. So that is called the contingent liability, because this liability is actually not showing in the picture or not showing in the books. But suppose that the company is, going to lose this case, then this liability would occur onto the company. So this is called the contingent liability. So you need to you need to go through the entire notes to account section, and also to the this auditors the report section, whether the auditor has objected to any particular item or not. And if so all these aspects are the things you need to consider when you are going to analyze the company's financials. So the three financial statements, again, the profit and loss account, the balance sheet, as well as the cash flow statement. Now, the profit and loss account. The profit and loss account statement is primarily the revenue of the company for a given period. It could be yearly, it could be quarterly, because in the listed space, the each and every company, as per the SEBI norms, each and every company have to produce the quarterly results, and in the end of the financial year, they need to produce the yearly results. So the revenue of the company, the expenses incurred to generate that revenue, tax and depreciation, earnings per share. Earning per share means EPS, and EPS is one of the prominent factor by which we do the valuation of the company. Right? We do the financial modeling. Financial modeling means the projection of the financials for the next 5 years or 6 years. Because in the stock market, what happens that the market always captures the future projection of the company, right? What the future projection would be there, that actually captures by the market. So you need to go for the financial modeling, that is the expansion of the projection of the financials for the next 5 years or 6 years down the line. And also you can get the EPS or the earning per share, that is the future earning per share, right? That is the forecasted earning per share, and by that way we need to go for the valuation of the company. So that is again, if you will be going through the the entirely nitty-gritty of the things, then you need to understand that how actually the EPS is calculated, how the price earning multiple is calculated, how the valuation of the company is is there. So then there are the two type of the assets. One is the tangible assets. Second one is the intangible assets. The tangible assets, which can be touch and feel. So this is called the tangible assets, and which cannot be touched or cannot be feel. That is called the intangible assets. So I mean, it's a very simple example. Suppose that the company is having one plant and machinery, because plant and machinery you can easily touch and feel. So that is called the tangible assets. But suppose that the company is having brand value, and now the brand value is such which cannot be touched, or cannot be feel. So this is called the intangible assets. But the value of the intangible assets is as important as the value of the tangible assets. You can take the example of ITC, you can take the example of Hindustan Unilever, you can take the example of Nestle. Suppose that the Nestle has the product of Maggie, and now the Maggie has got a lot of the intangible value, because each and every nook and corner of India where actually you go, each and everybody understand what the Maggie is all about, right? So that is called the difference between the tangible as well as the intangible assets. Now, in market, what actually happens that each and every time, most of the investors, the big investors, always feel that the debt free company is the best company to invest in. Now, you also need to understand you also need to understand that whether a debtless company or the debt free company is a good company or not. So why there is no debt? You need to understand that why there is no debt in the company, because always the cost of debt is less than the cost of equity. But if the company is going only for the equity dilution and not for the the debt, then again it's a question mark. So is it because the banks are refusing to lend to the company, or is it because the company is not taking initiative to expand their business operations? What's the reason behind it? So you need to go through it. Then the cash flow of the company. So there are the three kind of cash flow in the company: operating cash flow, investing cash flow, as well as the financing cash flow. Operating cash flow means whatever the cash flow is coming from the the day-to-day operations of the company. Investing cash flow means normally the company, if the company is having the reserves and surplus, then they go for the investing. They can go to invest in some startups. They can go to invest in some other assets. So this is called the investing activity, or the cash flow from the investing. And the financing. Financing means suppose that the company is going to get the debt, either it's a long-term debt or the short-term debt from the bankers. So this is called the cash flow from the financing. So that is the investing operations, cash flow from the operations, cash flow from the financing activity, and cash flow from the investing activity, right? So the healthy investing activities foretell the investor that the company is serious about its business expansion. Till now, there is any problem, or do you have any questions regarding this thing? Anybody? Please unmute yourself if you have any query or question regarding this till now.
Sir, can you see the chat box?
Just a moment. Chat box, there is no question as such. All of
Yes, sir.
the chats are related to the sites, slides are not visible and something like this. So
Yes,
there is
sir.
no question as such.
We can move ahead, sir.
Yeah, right. So that is the portfolio construction, and that is actually from my point of view. I mean, any investor can have different kind of portfolio constructions, but that is the typical the my portfolio construction. So that actually I'm giving you some guidance that I usually invest in the blue chip or the large cap companies. 30% of my capital, 20% to the select mid cap, 20% to the small or micro cap companies, 10% to the special situation stocks, and 20% from the SME space stocks. Right now, what is the large cap, mid cap, or the small or micro cap company? So,
Sir,
yeah,
sir, can you please share the screen, the presentation?
just a moment. In which tab? Uh, it is not showing. This is WZZ.
Sir, in the CUB one.
Just a moment.
Yes, sir.
In the CUV one.
The screen is visible, but the
Mhm.
slides are not. The presentation is not visible.
Just a moment. Now it's okay.
No, sir.
From
Sir,
my end, it's
please.
okay.
Sir,
Yeah,
yes, sir. Sir, please click on the PowerPoint where you have made the slides.
just a moment. Now, now it's okay.
No, sir.
Just a moment. Now it's okay.
Yes, sir.
Right. Yes. So, so what are the large cap, mid cap, and micro cap stocks? So, large cap means capitalization. Market capitalization is current market price of the share multiplied by the number of outstanding shares, right? So, in our market, there is no as such specification is there for for treating any companies as a large cap, mid cap, or small cap. But in our day to day conversation, suppose that the company is having more than 50,000 crores of market cap, then we treat it as a large cap stock. And if the company is having from the 20,000 crores to 50,000 crores of market cap, then we can treat it as a mid cap. And if this is a suppose that 1,000 crores or 2,000 crores to 20,000 crores, then we can treat that company as a small cap company. And the less than 2,000 crores of market cap company can be treated as a small cap company, right? So when actually we are going to put in, suppose that if you are investing in the this mutual fund, then obviously you must have heard the name that it's a the quant mid cap fund, or Mirai large cap fund, or it's a select mid cap fund, or it's a small cap fund. So these are the categorization of the companies on the basis of the market capitalization of the company, right? So that is the meaning of large cap, mid cap, small cap, as well as the micro cap. Now, so I have created some promising sectors for that is again for myself, right? So you can treat some other sectors as well for the as a promising sector in the market. So for me, nowadays the promising sectors could be the ITS companies, SaaS based companies, AI based companies, ML based companies, real estate ancillary companies, the banking space companies. So these are some promising sectors. So I'm just giving you some brief that how you are actually going to have going to analyze the the companies. So suppose that in the IT software sector, again, I mean, this is not the recommendation of buy or sell. It is only for the educational purpose. So in the IT software company, in the IT software space, there is a company called Datamatics. So now, so Datamatics, it's generally offers a wide range of services, primarily IT, VPN, big data analytics, and engineering services. Market cap is roughly 4,500 crores. PE ratio is 21.6. Higher the PE ratio, the the overvaluation is higher. So we always try to select those companies which is having the low P ratio. If the company is trading at a 10 P ratio or the 9 P ratio, so and the industry P ratio is suppose that 20, then we can say that the company is undervalued and we should invest in this kind of companies. So P ratio, if there is a P ratio on the higher side, it means that it is already overvalued and we should not invest in those companies, right? So in this case, the P ratio is 21/6. You have to compare the P ratio of this with the entire IT, IT space. And suppose that the IT space is having 30 or 35 multiple, and this is trading at a multiple of 21.6. So it means that this is the undervalued company, and you can think of investing in this company. ROC means return on capital employed, that is 24.1%. Year on year basis revenue growth 9.72%. So these are the couple of the parameters which you will have to use when you are actually analyzing the fundamental, if you are analyzing fundamentally any company. Then there is a company called the 63 Moons Technologies Private Limited. The company is engaged in the computer programming, consultancy, and related services. Market cap is 2,357 crores. Multiple is 18.5. ROC is quite low. It is only 2%, right? So return on capital employed is only 2%. Though year on year revenue growth is 250%, that's OP. And 3 year sales growth is 11.1%. Similarly, Oran Pro Solutions Limited. Then there is the Explio Solutions Limited. This is an Indian software services provider company primarily offering software validation and verification services to the global banking, financial services, and insurance industries. Key metrics is 2,056 crores of market cap, trading only at 17. ROC is 38.8%. That's very good. ROC roughly, if it is more than 25%, it is it is said that it's a good company. And ROE, there is another parameter called the ROE, return on equity, that should be greater than 18 or 20%. If the company is having the ROE is less than 18 or 20%, this is this is not a good sign, and this is not good for the investing in those companies. So year on year revenue growth is 6.6%. So similarly, artificial intelligence, this is again the promising sector nowadays for the any market. So there is another company that is listed in the Indian space, that is called the Netweb Technologies India Limited. The company has undertaken installation of 4,000 plus accelerator or GPU based AI systems and enterprise workstations, collaborates with the NVIDIA to unlock the potential of AI and high performance computing. Again, the market cap is 7,316 crores, and now see the multiple, the P ratio is 156. That's whooping. I mean, it's already too much overvalued, but because of the fact that there are only fewer companies are listed in the AI domain, so that's why the company is enjoying a multiple of 156. So that's too much undervalued. Return on capital employed is 64.4%. Operating profit margin is 15.7%. Debt equity is only 0.03. It means that company is virtually debt-free company, right? So now it is just I'm just showing you that how you are going to going to have analysis or the fundamental analysis of any company. So I have taken here one company that is called the TD Power Systems Limited. Again, this is not a buy recommendation, only just for the educational purpose I have made this the presentation on TD Power Systems. So firstly, you'll have to look for the business model of the company. The business model of the company, because it's a small cap company, leading manufacturers of the AC generators as electric motors, with the whole energy supply chain companies getting related. So I have given you, some investment rationale. So let's go with it. So TD Power System, what the company is doing currently, it's a prominent AC generator manufacturer offering a broad product range spanning from 1 to 250 MVA. The company offers a diversified product portfolio tailored to suit various types of turbines, steam, gas, hydro and wind, and engines, diesel and gas. Market cap is 4,600 crores. Current market price is 295, listed in NSE and BSE. Price earning ratio is 40, ROCE 22.1%, ROE 16.9%. These are the some metrics. Now the product portfolio. You need to understand what is the product portfolio of the company. So for generators for the turbines, steam, gas, hydro, wind. Then generator for the engines, generator for the special applications, motors. Then yeah, then this again actually the product portfolio which I've used. Now the revenue mix. What is the revenue mix? The 58.12% comes from the AC generator business, 21.14% comes from the AC generator spare parts, 17.29% comes from the power business overseas, 2.29% comes from the power project business overseas branches, and 0.58% comes from the power project business in land, right? Geography wise, 49% comes from the domestic market, 51% from the export market. The order book, you can have the order book, you can have the capex cycle. The expected capex for the expenses in financial 2024 is 150 crores. That is again we have taken from the annual report of the company in the management discussion and analysis section. Number of generators installed, manufacturing facilities. What are the projects where the company is doing the projects? Gas engine generators, geothermal, steam and gas turbine generators. Client concentration. The company's generator manufacturing revenue comes from the sales to turbine and engine OEMs, including the Siemens, White Hydro, General Electric, Triveni Turbine, etc. The top 10 clients contribute to 65 to 70% of the gross revenue. So again, actually, the entire 70% of the revenue comes only from the top 10 clients, and the rest 30% comes from the other clients, right? Key highlights. So it is a core manufacturing company in the power sector, completely debt free. Shareholding pattern, promoters are only having the 34.27%. FIIs is having the 10.11%. DIIs are having the 33.14%. Retailers are only having the 22.49%. And then there is the quarter two financial 24 financial highlights. Right. Future outlook we have already given. The company anticipates the significant growth from the offshore oil and gas, LNG markets, estimating the potential business worth 20 million euros over the next 3 years. That is again we have taken from the the company's management discussion and analysis as well as the director's report. The company expects to maintain the margins in line with the half yearly one first half performance. Indian Railways has issued the motor tender, and the company expects the securing approximately 80 motor contracts from the coming year. That is again from the order book segment. So this way we can analyze any company. In this entire thing, what actually one thing I would like to say that in our market, it doesn't mean that the person who is having very sound financial knowledge, suppose that the company is having a CA degree or the MBA finance degree or the MBA finance from any AMS, that doesn't imply that that guy is actually going to make a kill in the market, right? In this market, the scuttlebutt or the the common sense investing always plays a very prominent role. So each and every time, if you are an investor in the Indian market or any other market, you need to keep your eyes and opens are keep your eyes and ears are open. It means that each and every time you need to observe the things. Suppose that if you're going to the market and you're seeing that most of the guys are having this the relaxo chappal, then each and every time the one thing there must be coming into your mind that relaxo's earnings could get better in the coming quarter or the coming year. So I can give you one example. Suppose that if you are trying to analyze the car battery market, then it's very easy for you to, without going through the entire the annual report of several companies, Amar Raja Batteries, Excite, and etc. Just go to the the in your in your city's car market and talk to some of the stockists that which car battery is the sales figure of the car battery is what is the sales figure? Then which company is actually doing better in the car battery market? So every time the stockist would tell you that the Amron is actually a better choice because Amron is actually is a cheaper option for the any the car owner, and also actually the the return of the old car battery is fetching some good work. So every time, suppose that if you are analyzing the car tire market, suppose that, so then go and talk to the several tire stockists, and you would come to know that which company's tire is actually in the demand and which company's tire is not in the demand. So these are the couple of things where actually which you can try. So you can try, you can go to the market, you can observe the thing, you can do scuttlebutt, you can you can talk to the consumers that which the particular company's products are better or worse for you. So this kind of interview also fetch you some a good return. So that is from my side. If you have any questions, any queries, you can ask to me. Yes. Anybody having any questions? No questions. Okay. Right. So thank you from my side. No, this is not the first class. It was actually the summarization of fundamental analysis. If you need, then you can talk to your the financial. So that is. And if you have any for this particular the presentation, if you have any query or if you have any doubt or any idea or any any queries in your mind that how to do the business analysis, how to do the industry analysis, or whatever the questions come to your mind, you can unmute yourself and talk to me and ask to me. Long-term investment in crypto is good or bad since some coins blast up? See, I'm also the investor in the crypto space as well. So, though actually the crypto is, in the Indian government perspective, the Indian government is still undecided whether actually they are going to legal this crypto or not. So, from my point of view, I mean, because you have already seen the news that there are many KuCoin, Get.io, Binance, even is the is not opening in the the Indian apps as well as the website. So uh, uh, my advice to you at this point of time that you should keep away from the crypto market, because there is no there is no any clear direction from the government as such. So if you are if you are in India, if you are investing from through INR, then it's very difficult for you to keep pace with what the actually the what the the, because yesterday only the RBI has RBI governor has told that recently there was a news that Bitcoin ETF has SEC has already approved the Bitcoin ETF. But again, the yesterday only I was reading in a newspaper that the RBI governor told that whatever good for the US market does not hold good for the Indian market. So it means that they are in no way going to give any the legal thing for the crypto space as far as the Indian market is concerned. So I'm sure you just keep away from the investing in the crypto market. Any other question? And I'm sorry, there was some technical glitch because the the presentation was live from the three tabs. So there was there were some problem. There was not the clear view of the the presentation and all. I'm really sorry for that. So any other question if someone is having, please ask. So what's the take on the fundamentals of the Jubilant Foodworks? So because Jubilant Foodworks is a good company, so they are the master franchisee of the Domino's. So company is good, but again you need to understand that there are a lot of the because this is a quite unorganized market right now, because there are only two prominent players. One is the this Devyani International, which is having the master franchisee of the Pizza Hut, and then there is another the Jubilant Foods. So they are having the master franchisee of Domino's, and then there is the Burger Sing, and then Burger King, and then some many other unorganized players are also there. So though the fundamentals of Julian Foodworks is good enough, but I think they have saturated to that level. Now actually the quality of the Domino's is also not up to the mark if you go by go by my my view. So I don't think actually the Jubilant Foodworks is going to have very great run in the next 2 to 3 years down the line. So you can better analysis again the thing. Though the fundamentals are quite fine. I mean the management is actually good. So Vishnu Hari Bhartiya is the the promoter. So that's from my side on the Jubilant Foods. Any other query? All right. Okay, Piyush. So I think it's over from my side. There is no queries or questions right now. So
Yes, sir. We can end it here. Thank you, sir.
yeah. Thank you so much.